Welcome to Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services in Eastland, Texas. Tune in every week as we share important information to help you and your family live life on purpose. Insurance, investments, legacy and tax planning, and much more. All covered now on Life Planning 101.
Hi everyone, this is Kade Sparger on Black and White Market Minute on Life Planning 101. And today I'm joined with Aaron Kennedy and Sam Barker, who are going to give us a little bit about the market and what's going on in the world. How are y'all doing?
Hey, Kade.
Doing good. Happy to be here. Hope everybody's been having a great week.
Yep.
I don't know how much we're going to be talking about. We can give a quick update on the market. The market's been doing really, really well. You know, we hit the bottoms in April, and it's been shooting through the roof ever since. Hasn't been a lot of fun, but the market is positive. I believe the S&P's up some almost 5% right now.
Well, I've actually got today's numbers as of close. So the S&P year to date is up 5.9.
Nice.
The NASDAQ 5.6. The Dow 4.6. Then the Russell is about flat for the year.
It's been great, and it's been a very, very strange market. Momentum has really been what's driving everything higher. Been extremely strong up until yesterday. And we had a crack in momentum, came down, but that's kind of what we expect. It typically runs really hot and then gets a breather. Seems like everybody captures their gains, and then everybody gets scared of missing out on the next run, and it takes off again. So, not alarmed with that pattern at all, especially with everything's going on. You know, we got the big, beautiful bill, made it through the Senate. Now it's back at the House. Our trade deadline is, what, now?
July
4th.
Yeah.
July 9th, yeah. And lots of things are positive about that. There's been some really positive news. But, you know, with everything that's going on, the market's almost too calm to me. It's eerie. It's like right before the storm, you know, you start to smell the rain and crickets stop talking.
Yeah.
You know?
Well, it's always interesting if you get news to kind of watch what the market does on news days. So like today there was an ADP report for private payrolls. It came in, I think that it came in way under what we expected. I think it was negative actually. And they expected it to be positive 100,000, I think, if I'm not incorrect. And so, you know, whenever that headline came out around 7:20, 7:30 this morning, I got, you know, can't wait to look and see how the market reacts to that. And then it was flat to up at the open. So it's always interesting to see the headlines guessing what the market's thinking. You can see what the market's doing, obviously, in real time, but guessing what's causing those moves is always it's a crapshoot.
Are we excited that our economy's growing, or we excited that the economy is stagnating so we get lower interest rates?
Yep.
So, like you said, you never know. I think I've said that so many times. I love it when the people come out and say, this is why the market's doing this. Oh, Lord.
Yeah.
Well, and it's always funny asking what the market's doing, because what I see from a psychology standpoint is that, you know, they always say it's because of this big news story, or it's because of XYZ. People never say that it's because of how the people are reacting to the news, because I've seen it before. Especially, best example that I've ever seen in my life was there was a big storm down in the Gulf, and there was just probably a small little story that said, hey, we're going to be short on gas for a little bit. Well, people took that as, I got to go get gas right now. So they went and got gas to the point where there wasn't any gas. And so they just expedited and made it so much bigger than what was originally happening. I think that happens to the market all the time, to where someone's like, oh no, the market's bad today. And so what do people do? They stop spending money, they stop this, and it just makes it a whole lot worse than it really is what I've seen at least.
No, that's exactly right. That happens. I was listening to a micro-cap manager, and micro-caps are tiny companies, you know, in the hundreds of millions dollars. So in market cap compared to NVIDIA, that's tiny, but still good sized companies. Anyways, micro-cap manager, and one of his companies on his watch list just cratered, and trying to figure out what's going on. And it ended up being one of the inside holders had to liquidate, and there just was not enough volume. So there's a million reasons why the market goes down. At the end of the day, somebody was selling. More people that were selling. And who knows if it was because of the jobs report or my wife said I need to take her to Europe. Who knows? You know?
Well, and insider selling, no one knows what's causing him to do that. It could be financial struggles, but sounds like a heck of an opportunity.
Oh yeah, he said I think he made 40 to 60% within 2 months.
Yeah.
Just.
And going back to the economics of what you were saying, Kade, I mean, let's say everybody goes out and buys up the gasoline. You'd think initially it's like, oh, that stinks, nobody's getting gasoline. But then all those oil companies and gas companies are getting paid a lot more money to get the gas there a lot faster. That's, the mechanics of the market, bringing in supply when demand is there. I mean, that's always, those price economics are always fun to watch.
It's just a pendulum of it, is because it just all depends on if you look at it as half empty or half full on anything. Is there's always going to be opportunity in the down markets. There's always going to be some opportunity for somebody in the up market. It just depends on where you're sitting on the end of the equation. If you're not in the market and the market tanks, perfect opportunity for you to get in. And I mean, if it's going up and you're already in it, well then boom, you're in the opportune moment. So it just depends on where you're at in the situation.
It depends. I found my new favorite educational chart on the market when I was showing you that, Sam, and it was let me back up. You are both right. There's so much happens and there's so much up and down. It doesn't matter if we're looking at the market or economics. Anything that we do, you need to put some kind of smoothing effect into it to remove the dailies, So that's what I should have said first. Found my new favorite report, and I think we've all seen it, the chart of the S&P 500 where it just goes straight up and it looks basically calm and beautiful. Why wouldn't you want to do this? But you take that and you put it off of a percentage off high. So how big the drops are, that gets chaotic. That really looks like E.T.'s voice over, shortwave radio. It is awesome. Yeah, you get this beautiful line, but these are the things you have to overcome and stomach along the way. Smoothing is very, very important. And I know with investing, time is that smoothing effect. And don't watch TV or don't watch the news on TV. Don't look at your account values daily, and time will smooth everything out.
Right, and that's the biggest thing too whenever you're speaking of it and looking at investments is you see, like you said, if you zoom out enough, you see it's just an easy line that goes up. But as soon as you zoom it in on that day-to-day, it starts jumping. And so...
Where's Henry?
Right, exactly. We need our guy to look at that.
Yeah.
But it's definitely goes back to that holding out and letting it do what it's going to do, because as trends show, it's moved in the upwards direction if you look back far enough and you zoom out far enough.
Yeah, that's exactly right. So, Sam, I know you've been looking at this big, beautiful bill. What is this going to do? What is this going to do to the market?
Well, it depends on who you listen to. If you listen to one side of the aisle, then we're all going to be sitting on golden toilets in about 10 years. And if you listen to another side of the aisle, we're all going to be sitting in cardboard boxes. So, it's one of those things that if you go read the bill and have the Thomas Sowell mindset on economics as well as a crystal ball for the future, I think you can probably figure out what's going to happen in the next 10 years on our spending and our budget reconciliation and all the different things. But I think we're just going to have to look 10 years down the road and come back and look at headlines from today and see, probably nobody's right.
Probably
nobody's right.
Probably exactly right.
It's 948 pages. I will say, it kind of like Elon Musk said a few weeks ago, there's no such thing as a big, beautiful bill. There's either a big bill or a beautiful bill. And so I figured that's probably as close to right as you can get on these things.
Who was it? Was it Pelosi that said, I don't know, we're going to have to pass the bill before we can see what's in it?
I haven't seen that, but that's
please tell
about
me
right.
It's not one of those things.
I think that they've Mike Johnson has given the House, I think, 3 days from the time the Senate passed it to review the bill before before it gets voted on. But 3 days for 948 pages. I know they have teams of people that go through these things, but not only do you have to read it, but read it in context with the consequences in mind too. I mean, it's.
I have a bad feeling to that point. The people in Virginia are going to page 16. The people in North Dakota are going to page 137 to make sure they're getting what they want, and they don't. All the other stuff doesn't matter. And I can't remember which one of the states that does this, but it's only single issue bills. And I really wish we could get to that. And if we could do single issue bills, who wins? The American people. Every single time. Do we want this? Yes or no?
Yeah,
So many wants and wishes.
Well, and I was listening to a commentator, and he was talking about how we used to have, and I can't remember what he called it, but essentially they changed the rules in Congress, and the way that they had changed the rules, it went from congressmen and senators getting their names on a post office in place of exorbitant spending on whatever else the topic was of the day to the exorbitant spending of the topic of the day. And so it was, it looked a lot worse, and it was more aggravating to get a post office with your congressman's name in your town than it is to not ever see the consequences or to see the direct consequences of each page of the bill. But now what we're getting is increased spending that you can't keep track of. I mean, it's a big black box instead of a big beautiful bill.
I love the idea of keeping our taxes low. At the end of the day, I don't think anybody can disagree that money in an individual's pocket's worth a heck of a lot more than money in the government's pocket. Figuring out if Octopus can play cards or whatever that is, that's pretty much just a waste of money. Also, there was some Medicare stuff in there, cleaning that up, making sure they're wiping out the fraud there and the excessive spending. That's great. But golly, increasing the debt ceiling that much.
$5 trillion.
I know. So what all good work did Elon Musk do?
I think it was, they put it on the debt clock at this point.
Yeah, it's an enormous number. But increasing $5 trillion, it just doesn't mean anything now.
Yeah, I've got these numbers. This may be a segment that we need to do on this every time we do a podcast. I know it's weekly, but it seems to change so drastically from week to week. We currently sit $37 trillion in U.S. debt. Let me find the Doge numbers. The largest budget items, Medicare and Medicaid, Social Security, and then defense. Interest on the debt is sitting at $1.033 trillion. They might have pulled Doge off of here.
No way.
I wouldn't think so, but Trump and Elon going after each other. Let me see here.
It's hard to look at that thing. I don't know if anybody's looked at that, but it is absolutely fascinating. Just U.S. debt clock. Google that up, and you can see all of the spending, all of the revenue numbers, everything. And it is truly fascinating. And up there in the top right corner, you can change dates. You can go back to 1980. You can go back to different time periods and see where the U.S. was.
All right, I got it pulled up here. It's sitting at $540 billion, almost $541 billion of savings. That's almost $5,000 per taxpayer.
Oh, that's beautiful.
Yeah. So
I love that. But we're pretty much in a spiral now that we have to spend to continue to grow. And wasn't that me and you? I can't remember what day. We were just talking, and all the excess spending, like 80% of all of our spending was going towards interest, Medicare, and Social Security. All of it, 80%. So that's scary. That's very scary. And as time goes on, you can't put the genie back at the bottle.
what options are there?
Dun, dun, dun. No. This is getting risky. And we've been playing it for a lot of people. We've been buying Bitcoin and gold, trying to protect ourselves, getting into some hard currencies, real currencies that are not being manipulated by excessive printing. And I know there's a lot of people that have some really strong feelings about Bitcoin, especially, not so much gold, but I really think everybody needs to at least take 1% of their money, 1%, one penny out of a dollar, and go drop it into Bitcoin. If it blows up and it never works, you lost a penny. You ain't even going to pick it up off the ground. But if it does what it's supposed to, that's probably going to save you in the long run. 1 penny, one copper thing on the ground.
Or if you think about it, and how long is it going to take your portfolio to get that back? If you're, just the average portfolio would be 1 to 2 months of earnings.
Over a 10-year period, if you're all in stocks, it's going to cost you 0.1, or probably compounding 0.7, 0.6%. So nothing. And that's if it goes to zero. So, boy, look at your budget. Look at what you're paying for your car insurance, your house insurance. Why not have some, I was going to say life insurance. How about have some spending insurance? Let's put it that way.
Yeah. Well, and it seems like a trend in the American lifestyle has been, lately especially, let's take out a loan, even low interest rate or not, and buy some depreciating assets. Your cars, and I don't think your student loans would be depreciating, but I mean, you have depreciating assets, your Rangers, mostly vehicles, really.
Yeah.
Your toys, your everyday fun things.
Toys. That's your perfect thing.
And so
Toys.
I think it's pretty interesting. You take out a loan, you pay interest on a loan on something that depreciates. There might be a smarter way to do something like that.
Yeah. That's exactly right. And probably Kade can speak to this more than any of us, but having the wherewithal to understand what you're spending on and being able to save your money and spend it on the right things. You don't have to spend every single dollar you have. You need to have, what is the word I'm thinking of?
A budget?
Discipline?
Discipline.
There
Discipline.
we go.
Yeah. Please have the discipline to spend wisely.
We'd think being Jim's son, you'd know all about discipline.
Oh, yes, I know all about it.
Right.
It's just been beat out of me. Just teasing. Couldn't remember the word. Just couldn't.
Well, and I actually have 2 points to that. One, speaking on the, spending and whatnot, for the listeners out there, I do teach financial literacy over there at Texas Tech. But what I've seen is you always hear it in budgeting, is you have wants versus needs. And what you see, it kind of goes back to what I talked the last time I was on the podcast is, don't compare yourself to people who are playing a different game, because you always talk about wants and needs, but when you really start coming down to what is a want, what is a need when it comes to budgeting expenses, you end up finding that what might be a want for me is a need for somebody else. My best example was always that whenever I go get a haircut, I only need a $10 haircut. I don't have to do a whole bunch of my stuff with my hair. And so that would be a want if I wanted to go buy all the fancy products, all the fancy stuff. Looking at Sam. But then you have some people who need to have, people need to go get their hair done. They need all this special treatment for it to make sure that it looks good and whatnot. And that can be constituted as a need for them. Same thing with medication. I don't need certain medications, so I go buy vitamins to be healthy. That's a want for me, but there's some people who have to have blood pressure medication. That's a need. And so that's what you have to look at whenever you're saving. And the second point with all that is from the same book that I kind of spoke on, Psychology of Money. It talks about, why do you have to have a reason to save? The average American is always, what are you saving for? There's this goal. I'm saving for that new car. I'm saving for a house. Well, why don't we just take out that object and we just save to save? I'm just saving for that moment where I need that money.
Yeah.
You're not saving for a goal, because what that does is that doesn't attach it to anything. And so it can grow like it needs to. And then whenever you do need it, because we all know that when one thing happens, 10 more comes right along to attach itself, you're ready for it because you just saved to save.
Amen.
Well, and I was actually reading an article. Well, first of all, I'll defend myself a little bit. When you start having kids and losing hair, you start trying to, take a little bit better care of it. So
Yeah, that's fair.
a little bit more expensive haircut kind of goes a long ways, but until I can't get haircuts anymore. I was reading about kind of the modern monetary theory and some of the things that goes into, if you go out and you spend money, it goes into a business which employs people. And I know that recently there was a big wedding. I think it was one of the tech billionaires spent between $25 and $50 million on their wedding.
Yes, could
with
you imagine?
soap baths and all kinds of stuff on a yacht. I don't know the whole story. I haven't looked into it, but
Must have lost my invitation in the mail or something.
yeah.
I guess.
I heard somebody complaining, and I say complaining, that might come off wrong, but they were talking about how much it cost and how many mouths you could feed with $25 million. And if you look at it from another lens, you are feeding mouths when you spend
Yeah.
money, right? So
Every dollar spent is feeding somebody else.
that's right.
So someone's doing that service. You're buying a good from some company that's paying their employees. So important in the U.S. economy, especially, that dollars are spent, because all of that's feeding other people.
Well, and I was even reading dollars that are saved. Let's go deposit our money, assuming we have an adequate savings. We deposit that savings into a bank. What's that bank going to do? They're going to turn around and lend it. They're going to lend it to a company. That company is going to use that money to go out and build, which employs people. I mean, whatever you do with your money, the market, and when I say the market, not the stock market, but the broad-based capitalistic market is going to find efficient uses for those funds. Yeah. So, the excuse of I've got to spend this money on whatever I want today to go make sure somebody else is employed, that can be turned around back on you. Why don't you save that and offer the bank an opportunity to lend that money to somebody?
Now we're talking about the velocity of money.
Yeah.
So I put my $100 in, bank lends it out, next person spends it, they take that money, put it in the bank lends that back out again, and just over and over again, and my $100 can, what is it now, turn into $800 just in the blink of an eye. And it's just moving through the economy. It's just the way the banking system works. And it's absolutely, it's beautiful, but it has to happen. So the more we spend, the better off we are. And we were looking at that today. The top 10% of our population spends almost 50% in our economy. 50 is like 49.5%. The top 10, so they're carrying the load. And he asked me a question of how much on that 10% do I want to take away from them? Do I want to tax? If I tax out 15%, do you want all of our consumer spending to drop by 15%? Or do you even want it to slow down? I mean, that's the driver of our economy. So why? To me, let's control our spending and let this government spending and let the consumer go wild.
And I think that's an important piece, is to both of y'all's point, is that money should always, the economy, I should say, is cyclical. Of course, that's what we all learned in class. That's just kind of how it works. But money should always be in some form or fashion flowing. Now, that doesn't mean it leaves my hand, it leaves my bank account. But like Sam said, and like you said, Aaron, is that we put it in the bank account, the bank starts using it to starts loaning it to other people, because that's what fuels the economy. Like you said, is that we are spending money. And so that's why whenever we talk about saving and whatnot, we're not saying that you shouldn't have anything in your bank account. Have enough that you're feeling comfortable, you can pay for everything, things. But anything above that, go put it in a savings account that's getting you a good interest rate. Then the way that we look at that is, if you don't need it within a year, definitely put it in a savings. If you don't need it within 6 months, typically put it into a savings account. Yeah. And then after, if it's going to be longer than a year, if it's money that you're like, yeah, I won't touch that for a while, that's when you get into investments and stuff.
Then you invest.
Because that's what's going to the investment drives the businesses to do bigger things, and that's what's going to just drive it more and more for the better. And that's why you see whenever people say the markets are down, what happens? People get scared. They stop spending, which again goes back to my earlier point. It just makes the whole situation kind of freeze in the economy because the money's not moving anymore. Everyone's scared to touch it.
And you nailed it. Our sleep at night money, have that in your savings account. Mm-hmm. Once you get out of, this is what I have to have, invest that money. Build. And that's all it is. Build with that money. Spend a day, build, sleep at night. And that's the only three things you got to figure out. And then once you do, you can have a successful, meaningful,
Less stressful.
Yes,
yeah, that's the
yes.
biggest thing is you're not going to have as much stress once you hit those buckets. That's
Yeah.
what we always talk to our clients is we want to have you a bucket that's ready on the go when you need it. We have a bucket just in case in about a year that we can kind of access, and then we have a bucket that's for those long-term plans and goals that's just growing.
Amen.
So, what's the market going to do for the rest of the year, Aaron?
Yeah,
It's
pull
gonna
out.
go
your-
up.
Yeah.
And it's going to go down. And it's going to go up again, and it's going to go down. No, I think it's going to be. I think we're going to have a good market this year. Now we're already up 5%, so I don't know how much more it goes up from today. But I think there's so much fear built in over silly things like tariffs and big beautiful bills and everything else. I think we're discounted right now. I really think we're discounted. We talked about this last week that there are some fantastic companies out there that are just beat up, and no reason we can figure out. I love it when we start digging in and we're like, I'm going to figure out what's broken with this company, and by the end of it, I'm selling my kids' clothes so I can buy more of the stock.
And it kind of sounds like we're wrapping up a little bit, so I want to talk a little bit about the planning side of it, because you touched on a good point about it being on a discount where, when we look at taxes and tax brackets, because as we know, financial planning is mostly the market, but then when you pull in other stuff to it. So I really wanted to touch on today is Roth conversions, because I know that we talk a lot about them, Aaron.
Oh, yes.
And I think that since we're in a discount, some people don't think about it. Typically, when we look at tax brackets and we're in a pretty historically low tax bracket range, right? Like, would you say so? Or
Yes. Probably for the foreseeable future. Probably lowest in my life.
right? So that gives us what, 2 years?
Good gosh.
So
Let's stay making fun of Sam's hair.
oh, sorry,
Keep
sorry.
out of my age.
Or lack thereof. So whenever we look at those Roth conversions, though, and just for those who aren't aware, what a Roth conversion would do is you take your IRAs that are taxable when you pull it out. You go ahead and pay the taxes today, put it in that account, and let it grow tax-free. So when you have an emergency 50 years down the road, you pull it out. You don't have to worry about the tax implications. And the way that we look at it is that since historically we're in these low tax rates, most likely these tax brackets are going to go up over time. It's going to get to where you're maybe paying more taxes over time. And so it's always important, if you have those IRAs and you can stomach the taxes in the year, make sure to go and do those Roth conversions, because the way that I've always looked at it is if you have a traditional IRA that has $10,000 and it grows to $1 million in your time, you got to pay $1 million worth of taxes. Or you convert that $10,000 into Roth IRAs, then it grows to $1 million. Well, that's $1 million of tax-free money.
Yeah. It is one of the most biggest, beautiful.
Accounts.
Wow.
Yeah. And really, only someone's going to benefit. But who's Brent? You and Brent were talking about that.
Yes.
You only have to stay alive to benefit from that. Rule of 72, the market's going to double every 7.2 years. So even if you're paying 30% to do that Roth conversion, you do what I tell you and you stay alive. 7 years down the road, you're paying 15. You do what I tell you, stay alive again, then you're paying 7.5%. Just stay alive, and it's.
Well, and not only that, but you also think about it from an estate planning standpoint.
Yeah.
Say that the unfortunate happens, you passed on whatever that is to tax-free money to your children.
Yeah.
Who?
That's a 10-year wait, right?
Yeah,
so
you got it.
That cut the tax bracket in half right there.
Mm-hmm.
So wherever you're at, somebody's going to benefit.
Yes.
Going back to taxes, I skipped over, once y'all started insulting me, some of the statistics I wanted to touch base on this one big, beautiful bill. I said early on, if you listen to one side or the other, you're probably going to get it wrong. I did pull some reports from some of the supposedly apolitical organizations that go through these things. And the estimated tax savings by implementing this is going to be about $1,700 per family of four.
Nice.
So without the extension of the 17 tax cuts, you'd pay an additional $1,700 per family of four. And these are based on estimates, obviously. Everybody's tax situation is different. So whenever you hear somebody say a 67% tax increase, it's not that you're going to pay 67% more. The reference there, although they don't ever explicitly say this, is going to be between 63 and 67% of people would experience a tax increase of some kind. So that's
that
put into
sense.
context that, might settle your nerves a little bit.
Do we have time to tell that little story? The 67%. I was reading something this morning, and total political. It was on vaccines, and the way they worded it was in a year-long or 10-year time frame. 17 children passed away for unknown reasons. 23 children passed away during the same time frame because of the vaccines, with the vaccines added. So if you take vaccines, there's a 25% greater chance that you're going to pass away. And it's just like, no, math doesn't work that way. It wasn't 5, it was 3 people. So 3 out of 100 or 3 out of 1,000 or 3 out of 10,000. It was not 25% greater because I threw some arbitrary number in there.
Yeah,
Anyways.
you got to look at the cause of death in those situations,
Yeah.
the context. I mean, it seems like everything in media is taken out of context for a political purpose.
Yes, oh my gosh.
Well, and then to add to that, it's also, I would say, almost in a negative way too. There's to the point with vaccines, you're always talking about. I saw this a lot in COVID. Was the numbers that you always saw on the news was how many people passed away because of COVID. It was never how many people recovered, how many people got better. Which now that may not be as powerful, but it gives a good twist on it of whether or not how the news spins things. That they're always going to spin that more negative connotation.
You can say that stuff and be absolutely right.
Right.
Is it reality? No. Not at all. Anyways, didn't mean to interrupt.
Oh, sorry. Yeah.
I was done. I mean, my hair's about gone, so.
No, it's beautiful. It's big and beautiful.
Just like that bald spot in the back.
Look like Donald Trump. All right, thanks everybody. That's going to be another episode of Black and White Market Minute on Life Planning 101.
Thank you for joining us for Life Planning 101, brought to you by Smart Money Group and Kennedy Financial Services. If you have questions, you can email them to lifeplanning@kennedy-financial.com. Be sure to tune in next week for more Life Planning 101. The opinions expressed herein are those of the firm and are subject to change without notice. The opinions referenced are as of the date of publication and are subject to change due to changes in the market or economic conditions and may not necessarily come to pass. Any opinions, projections, or forward-looking statements expressed herein are solely those of the author, may differ from the views or opinions expressed by other areas of the firm, and are only for general informational purposes as of the date indicated. Securities offered through Calton & Associates Incorporated, a registered investment advisor, member FINRA SIPC. Investment advisory services offered through Smart Money Group LLC. Kennedy Financial Services and Smart Money Group LLC are separate entities and are not owned or controlled by Calton & Associates Incorporated.